Hello and welcome to this special edition of the State of the Economy. I'm Lata Venkatesh, and what we are discussing are two important macro numbers that have just been announced by the National Statistics Organization. The CPI inflation for the month of February has dipped to a 7-month low of 3.61%. Now that's compares with a CNBC TV18 poll of 3.85. So a good over 20 basis points lower than what the street expected, but more importantly, 40 basis points below the mandated level at which inflation needs to be kept by the Monetary Policy Committee, which is 4%. The other delight in the data is that the index of industrial production for January has come in at 5%, and the CNBC TV18 poll was, I think, 3 or 3.6%. So it's much better than what the CNBC TV18 poll indicated or what the market was expecting. Double delight in terms of growth being higher than expected for January and inflation being lower than expected for the month of February. In particular, the food inflation has come in at 3.75. The CNBC TV18 poll was 4%, and the January inflation was 6%. I must add as well that for the previous 18 months, food inflation has been between 8 and 11%. So that drives home the importance of the 3.75 food inflation that we have achieved. It is a sight for sore eyes. With that initial preface, let me invite the experts whom we have lined up on the show for you. Joining me to discuss the IIP and the CPI numbers are Aditi Nayar, the Chief Economist of rating agency ICRA, Devang Shah, the Head of Fixed Income at Axis Mutual Fund, Sameer Narang, the Head of Economic Research at ICICI Bank, and Radhika Rao, the Executive Director and Senior Economist at DBS Bank. Ladies and gentlemen, thank you very much indeed for your time. Radhika, I'm going to start with you because the sun is perhaps already set in Singapore, so you get the privilege to leave the show early. What have you made of the inflation numbers? Are they a pleasant surprise for you too?
Hi, Lata. Certainly, I think both the numbers, IIP and inflation, have moved in the right direction. Inflation has come down much faster, the 7-month low. And I think when you see the components is mainly driven by food, as was largely expected. In fact, if you see year-on-year number in terms of the sub-segments among food, you really see the relief in pressure, especially in the vegetables. It's declined on the year-on-year terms, and certain other categories like pulses as well. Certainly a good number to have, and I think from the central bank point of view, this is exactly what they were wanting to do, which is to not only bring it back into the target range, but below the midpoint or towards the midpoint. Of course, the next question thereafter becomes, is it going to be sustainable, durable, will it remain close to 4%? I think at least for the next couple of prints, it does look like that. Thereafter, of course, probably in the interview we will talk about it, that you will have other things that might play in the hand. But just like high frequency numbers have suggested, certainly inflation being lower is a very good piece of news.
Okay. Well, actually, the Reserve Bank number is 4.4 for the full quarter. Jan, Feb, March, Q4. That was the forecast they put out. But now we are having an average of, I think, 3.85 or thereabouts for Jan and Feb. So, Sameer, that question to you, what would your March number be? And do you think we will seriously undershoot what the Reserve Bank forecast?
So, in March, veggie prices are pretty much flat as of now. So, if you look at that trend, the number for March comes around 4%. And that implies closer to 40 basis points undershoot from where the RBI's number was for 4.4%. And let me add that if you go back a little bit in history and observe whenever veggie prices or food inflation has remained elevated for, as you pointed out in your introductory remarks, for a period of 18 to 20 or 24 months, the next 2 to 3 years, food inflation has been very benign. So you could see a situation in which the RBI is likely to hit its target over the next 2 to 3 years on a durable basis. Having said that, the international equations also in terms of commodity prices and oil would also have to fit in well with that forecast.
Okay. Literally, tumhare muh mein ghee shakkar. If it is going to be, lower food prices for the next 2 to 3 years, because it has been the bugbear. It has been the government's and the Reserve Bank's headache. A lower food inflation will also mean more money available in the hands of people to shop. and therefore it will be a definite growth booster, something which the Reserve Bank has repeatedly been saying, that even if food inflation cannot be controlled by interest rates, the point is it leaves less for growth, and therefore we have to control inflation as well. Aditi Nayar, would you want to change any of your forecasts now? Your current year's forecast as well as next year's GDP forecast, CPI forecast?
So Lata, for March, I broadly agree with Sameer. We're also expecting an uptick to about 3.9 to 4%, and therefore for the full year, our number is now coming in at 4.7% instead of 4.8% for the CPI. For next year, certainly today's number is going to kind of, have to feed into the trajectory the way that we're forecasting it over the next year. As of now, we were at 4.2%. I'm not sure we're going to lower it too much in terms of the FY26 CPI inflation number. Having said that, it's definitely a relief to have food inflation coming off when overall the global economy is in so much flux. It certainly gives us a lot more leverage to be able to deal with an unfolding, growth inflation dynamic situation.
Okay. The important point to ask all of you is whether you all are changing the number of rate cuts expected from RBI. But before I come to that, let me get to the most important person now. Devang, will the markets react at all, or are you going to hold out because we are now so following what is happening in the US?
So the markets are on the time. Probably if you look across, they have behaved positively to the CPI release. We have actually seen yields ticking down by around 1 to 2 basis across the curve. Our perspective is that somewhere down the line at this point of time, yes, obviously government bond yields should trend lower, but a lot of other options are available to investors. We have looked across, thanks to the increased supply on the corporate bond side. We have a mammoth supply this quarter in SDLs. So all this put together, investors have a lot of options. That is why probably they are shifting to other asset classes like corporate bonds and SDLs and probably switching out from government bonds. That is why we are not seeing the rally in bonds. Coming to your specific question on this CPI print, definitely leads to positive momentum for the bond markets, and definitely we believe that April rate cuts is definitely on the card. US CPI will be looked at. But our perspective is, I think somewhere down the line, people have now started focusing more on the growth side than the inflation, because the actions from Trump has been quite slower than anticipated on tariffs and other policies. And that is why I think somewhere down the line, the US growth trajectory is now looked at more closely, where people have started forecasting a contraction in this quarter. So our view is that yes, this print is definitely positive, and global data at this point of time is not too much of a worry.
Okay. No, actually, with President Trump saying that, a temporary recession may be on the cards or something to that effect, I agree with you that that is weighing down on bond yields. But let me first clear out what we are expecting in India itself. Radhika Rao, after looking at these numbers, what is your expectation in terms of the April policy, and how many rate cuts?
Charlotte, just before going into the RBI response mechanism, I think I just want to also make a point that core inflation has actually ticked up. It has gone up to about 3.95% from 3.6, 3.7 the month before. But I would really put that all to the personal care segment under miscellaneous, which has got to do with the gold prices. So I don't think again that will be much of a hurdle. It used to be mentioned in the past by the central bank that that is a source of worry. So not so much that as well at this point. Coming back to your question, no, we haven't changed our call after this reduction in inflation. We were expecting a 25 basis points this kind of in April, and this kind of cements that. I think the bigger question I would think would be again about the stance of policy, whether that changes or not, and I wouldn't be surprised if that were to change from neutral to accommodative. I think that's when there'll be a very clear signal that move down is the only way that the central bank is exploring. And of course, they have done a lot more along with just rate cuts, right? They've done macroprudential easing. They've also taken a lot of proactive steps on the liquidity front. So they're really going all hands on deck in terms of trying to stimulate the economy. So certainly 125 expected in April, and I'm holding up another 25 within the second quarter of the calendar year.
Okay, so 2 cuts and a change in stance is what you would pencil in April itself, Radhika?
Yes, that's what I'm hoping. I think that would really kind of validate and align with what their key response has been overall.
Fair enough. Samir, what would be your expectations April and thereafter?
So April, yes, a rate cut, possible change in stance as well. Effectively, Lata, what they've done in terms of injecting liquidity, durable liquidity in the month of March, by month of March itself, effectively, in terms of durable liquidity, the stance perhaps already changed. So we wait and see what they do in terms of the April policy, in terms of voting on that stance. And in terms of thereafter, we do expect one more rate cut after April. If growth numbers and inflation align, that could be front-loaded in June, or it could happen later in the year, depending on how growth inflation mix pans out. But given the global backdrop, things have become favorable in terms of policy framework in India than earlier, what we have seen, particularly in terms of dollar index.
Okay. So you're saying that we are going to see a rate cut in April itself. That is the consensus view. I'll come to Devang in just a minute. But Aditi, what are your expectations in terms of rate cuts? Would you agree 2 more cuts and change in stance in April?
So Lata, definitely a rate cut in April. I'm not so sure on whether we'll get a change in stance in that policy meeting or not. And I think for the timing of the subsequent rate cut, which we're also expecting, the data that we'll get at the end of May for the Q4 GDP will be quite important to basically guide whether we do get that final rate cut in the June policy, or does it get deferred to maybe the August policy. As of now, if we look at what is implicit in the NSO's estimates for Q4, it's a very sharp upturn in the GDP growth with a very mild upturn, or rather a milder upturn in the GVA growth. There is, it's coming in from an expected contraction in subsidies in Q4. Our own view is that the upturn in the GDP growth may not be as sharp as what the NSO's implicit numbers are suggesting. So overall, I think, it'll be interesting to see finally what kind of numbers we'll get. We'll end up with another round of revisions for Q1 to Q3 as well in the May data. And that would really guide what happens in the June policy.
No, I'm taken by what Radhika is saying in terms of a change in stance, also because the month of May should also see the declaration of the RBI dividend. And while they have infused a lot of liquidity, that is something seen like between 2.5 and 3 lakh crore. Ahead of that, if you're still going to stay neutral, then the accommodation is very clear. There is going to be liquidity of a unprecedented level compared to the previous 2 months. So, is there an argument, Aditi, that you might as well change the stance in April, because you are going to give liquidity in May?
That's a good argument, I think, Lata. That is something that we could end up seeing. Of course, the exact quantum of the dividend, how different it is from last year, the timing is going to be the same as last year. I think the question is basically on the delta. And of course,
no, I agree with that. Yeah.
Government spending will start much earlier than it did last year also. So that's going to be another factor that's going to help liquidity.
No, I take your point, because the RBI also announced that they have put in an internal committee, because the Bimal Jalan committee on capital requires that it should be reviewed once in 5 years or something, and that's come up for review. So it's possible that they want to keep a little more capital and not declare the entire, I think, 3.5 lakh crore. If you do the math, the RBI has only sold even more, so their dividend will actually be higher. But the point is, there is going to be plentiful liquidity. Samir, you want to take a jab? Given the liquidity ahead, you think there could be a change in stance?
So I agree with you, Lata. In fact, in the month of March itself, they injected 1.9 lakh crores of, proposed to inject 1.9 lakh crores of durable liquidity. So the March end number on durable liquidity will be in excess of 1 lakh crore itself. So that tells you that on paper, in fact, from durable liquidity standpoint, the stance has effectively changed. And given the dividend could be closer to 3 lakh crores, you are looking at a situation where durable liquidity remains in surplus for an elongated period of time. And that implies that effectively, from a durable standpoint, the stance is accommodative.
Okay, could be accommodative. Then that makes for a sea change. Devang, now to you. by the time we come to April, it looks like the repo rate is going to be 6, and by the time we come to June, if you go by the votes here, it could even be 5.75, and then you're going to have a great deal of liquidity. So tell us, what do you see in terms of the 10-year in April itself, first in March end, then April, and then June?
Yeah, we believe that, so I agree with large part of the panelists and what you spoke across. In fact, we think so that now liquidity is going to remain surplus for most part of the second half of the year. So somewhere down the line with the liquidity and possible rate cuts, we believe that by March end, 10-year G-Sec yield should be close to 660, and getting into April to June quarter, it should trade between 640 to 650 levels. So that's our view on the on bonds. I just put across that, as I highlighted, I think because now we are looking at liquidity significantly in a surplus zone, I think somewhere down the line, the spread trades and the short-term bonds also will make a lot of sense. 3-year, 5-year corporate bonds today are available at 7.5, 760 levels. They will make a lot of sense getting into the next quarter, where you are looking at a 575 kind of an operative rate. The corporate bonds can't trade at such high elevated levels. So I think investors will have a lot of opportunities into the next quarter, and it's going to be a good quarter for bond markets.
Okay. Well, there are 2 points that emanate from what you are saying, Devang, that cost of capital is going to fall a lot. That will mean that corporates, we could see much better numbers in terms of growth. And the second point that we are not discussing is there is a big external unknown in terms of what happens on April 1st or April 2nd in terms of reciprocal tariffs. And then if there is, external imbalance or external threats, can the Reserve Bank be so loose in its policy? Will there be still some problems in terms of currency? Both those questions after a very short break. Welcome back to our special State of the Economy show. We've just been discussing the lower than expected CPI print that we have got for February. The print has come in at 3.61 against expectations of 3.85 and against an MPC target of 4%. We've also got an industrial output number which is higher than expected at 5%. The CNBC poll was much lower than even 4%. Joining me, speaking to me on these issues were Aditi Nayar of ICRA, Sameer Narang of ICICI, Devang Shah of Axis Mutual Fund, and Radhika Rao of DBS. Ladies and gentlemen, thank you very much for your patience. Radhika, we also have a higher than expected IIP number at 5%, which we didn't discuss. And as all of you agreed, there is a clear lower cost of capital coming for corporates. So are you wanting to pencil in a higher growth number in the coming months?
Certainly, so IIP number has surprised on the upside, and if I caught the internals right, it seems to show buoyancy in the infra and construction sector as well as capital goods sector. Now, if that is the case, that is actually reflecting, to my mind, what is happening on the center's capex plans. After a lull of about 6 to 8 months, we've actually seen a sharp pickup, especially in December and January, and I think some of that is percolating through the headline. So certainly encouraging from that point of view. Consumer durables, non-durables, again, a bit lackluster, but overall at the headline level, I think it bodes well. But at this point, I would think this is an assumption we have already made into our GDP numbers, that government's capex is going to be a point of support. Real purchasing power improving because of lower inflation is another point that we have already assumed. So I don't think that would justify a change in forecast as of now.
Okay.
And, just like Aditi mentioned, there's going to be a bit of a mathematical influence on the real GDP at the headline level, but really at that point we should look at the GVA for the what's happening in terms of the momentum. So
no, I agree with you. No, GDP is a huge googly. But what is your just the number? What are you standing at for the FY26 GDP? And I mean, you're not likely to change it. What is that number?
For FY26, we are looking at about 6.4%, and we have not changed that. For FY25, we are close to where the consensus is about 6.4, 6.5%.
Okay. Sameer, yeah, I get your point. Sameer, just wanted to highlight that the manufacturing number has come in at 5.5. That is the bulk of the IIP number. What is let down and come to 5 is electricity coming in at 2.4%, could be seasonal as well. and mining coming in at 4.4, but manufacturing coming at 5.5, and the April-January number is actually 4.2. So really this stands out, and as Radhika already pointed out, very good capex numbers. If you looked at both December and January, capex, infrastructure, consumer durables, all of them are running north of 7.5%. Your views on growth, both FY25-26?
So, very true, Radha. January, great month. February, not so much. If you look at some of the high frequency indicators, particularly retail sales for two-wheeler passenger vehicles was a bit soft. But electricity picked up in the month of Feb, so that was good news. Overall, mixed bag, I would say, in Feb. Jan was much better. And our number for Q4 is around 7%. That's a tad bit lower than what is implied in the CSO estimate. So overall for the year, our growth number is 6.3, and we see it going up to 6.5% next year, essentially driven by consumption push that has come from the budget.
0.3 you said, your GDP for next year?
No, next year is 6.5, this year is 6.3, but the Q4 ending is 7%.
I get that. Yeah, I'm hoping, of course, that will be a big fuel for the stock markets, just the sight of the number 7. Aditi, your FY26 number?
So Lata, just to add to what Sameer said, for February 2025, unfortunately the base effects are on the negative side because we had a leap month last year. So that's part of the reason that the high frequencies are looking duller than they were for the month of January. For FY25 as a whole, we're looking at a GDP growth of 6.3%, and FY26 we expect it to climb up to 6.5%.
Okay, so no one's going above 6.5. I can understand the global headwinds are serious, especially if there is a US recession. Final question to you, Devang. What is your year-end, December 31, 10-year number? If I heard you right, the lowest we will go to is 6.4?
Yes. So I think probably as everyone explained, I think growth is coming around 6.5%. So it is not somewhere that India is going to a significant down cycle. Yes, inflation is on a positive surprise, and for the near term, we don't see any kind of concerns on a significant uptick on inflation. Probably inflation should settle around 4%. With that perspective, I think RBI is looking at rate cuts. RBI has done a lot of quick fixes to liquidity. They have actually stabilized currencies, allowed currency to depreciate around 3-4% in the last 3 months. So our perspective is that growth is getting a cushion. They probably might do a 25, and as you highlighted, because global headwinds still continue, they should not be significantly aggressive. So 25 is given, keep the liquidity comfortable and ensure credit growth and growth back to the economy. With all this context on the macro side, we don't see yields significantly falling below 640-45 levels. The only reason can be if for some reasons Bloomberg adds us to the indices, that it comes for review in September, and if they add us in the global aggregator index, then somewhere down the line we get a 25-30 billion of flows. That can be the reason which leads to 10-year bond yields going below 640. Otherwise, our perspective is that 646.5 is where we see 10-year yields going into this cycle.
Fair point. Thank you very much, Devang, for that explanation that, we cannot take the last rate cut, the third rate cut of this cycle for granted, simply because we could be faced with global headwinds. We will have to wait and see on that, if it is a recession or is it, great turbulence because of reciprocal tariffs. But otherwise, the set of takeaways from today's numbers and the prognosis for the months seem fairly positive. Thank you very much, Aditi, Devang, Sameer and Radhika for joining me in this conversation. Key takeaways on the state of the economy: inflation number lower than expected, and therefore the Reserve Bank may bring down the quarterly estimate. The Reserve Bank's estimate for Jan, Feb, March is 4.4. We may end up even south of 4. So that makes the April rate cut almost a given. The fact that there will be a Reserve Bank dividend in the third week of May also indicates liquidity will be plentiful, and therefore perhaps the third rate cut may not be in June, could get postponed given global headwinds. The important part is that the food inflation fear seems definitely out of the way, with the food inflation for February coming in way lower than January and even lower than the CNBC TV18 poll, coming in at 3.75%, a number we have not seen in years, maybe probably for 3 years we have not seen that kind of a low food inflation number. IIP number stronger than expected at 5%, but there the only color is, will that continue in February? As our experts pointed out, the two-wheeler sales, etc. for February are a little under the weather, so we have to wait and see. But nevertheless, with rate cuts, with so much of liquidity and rate cuts, the expectation is that growth should be good in FY26. That's it on this edition of State of the Economy. Thank you very much for watching. More news and updates are lined up for you.